empowering your financial journey. Hey there, future investors. Welcome back to Money Matters. If you're tuning in today, you're about to embark on an exciting journey into the world of stocks. Whether you're a total newbie or just looking to brush up on the basics, you're in the right place. Today, we're diving headfirst into a topic that's close to my heart: investing in stocks for beginners. So, grab a seat, and let's get those financial engines revved up. Hey everyone, I'm Tony, and I'm thrilled to have you here today. Today's video is special because we're going back to the basics and discussing a topic that's incredibly close to my heart: investing in stocks for beginners. Whether you've never dipped your toes in the stock market or you're looking for a refresher, this video is tailor-made for you. We're going to break it all down in a friendly, easy-to-understand, and enthusiastic way. By the end of this journey, you'll have a solid foundation to start your own investing adventure. So, let's not waste any more time, let's jump right in. Definition of stocks. Alright, let's kick things off by talking about what exactly stocks are. Think of a stock as a slice of a big, delicious pizza that is a company. When you own a stock, you own a little piece of that company. It's like being a mini-boss in your favorite video game, but instead of a virtual world, you're getting a say in a real-life company's decisions. Ownership in a company. Now, here's the exciting part: ownership. When you hold a stock, you're not just holding a fancy certificate, you're a part owner of that company. Imagine having a say in your favorite local cafe, what coffee blends to offer, or even suggesting a new pastry. That's the power of owning stocks. Your voice, in a small way, contributes to the company's decisions and, ultimately, its success. The stock market. Alright, picture this: the stock market is like a grand bazaar, where people buy and sell these slices of companies. It's where all the action happens. Companies list their stocks on the stock market so folks like you and me can buy them. And the best part? The stock market is open for business almost every weekday. It's like a bustling marketplace of ideas, dreams, and investments. It might sound a tad overwhelming at first, but don't you worry. We're here to break it all down and make it as clear as a sunny day. Let's dive into why investing in stocks is such a fantastic idea. Potential for long-term wealth accumulation. Now, let's talk about why you should consider investing in stocks. It's like planting a seed and watching it grow into a mighty oak tree. Investing in stocks has the potential for long-term wealth accumulation. Over time, the value of your investments can increase, thanks to the growth of the companies you've invested in. It's like having your money work for you while you go about your day. Historical performance of the stock market. If you're wondering if this is just a shot in the dark, let me assure you, it's not. The stock market has a track record that's nothing short of impressive. Over the years, it's shown a remarkable ability to grow, even through ups and downs. Of course, there are no guarantees, but history has shown that, on average, investing in stocks has been one of the most effective ways to build wealth over the long haul. Diversification benefits. Now, here's a nifty trick in the world of investing: diversification. It's like having a mixed bag of candies instead of putting all your hopes in just one flavor. When you invest in a variety of different stocks, you spread out your risk. If one company's stock isn't doing so hot, the others might be doing just fine. It's a smart way to balance potential gains with potential losses. We'll dive deeper into this concept later on, but for now, just know that it's one of the many tools in an investor's toolkit. Let's break down the important concept of risk and return. The risk-return trade-off. Alright, let's chat about something crucial in the world of investing: the risk-return trade-off. Imagine you're on a seesaw. On one end, you've got risk, and on the other, return. It's a bit like a dance between adventure and reward. Generally, if you're willing to take on more risk, there's potential for higher returns. But, and it's a big but, it also means there's a chance of higher losses. On the flip side, if you prefer to play it safe, the potential returns might be more modest, but the risk of losing big is lower. Finding that sweet spot that suits your comfort level is key. The concept of volatility. Now, let's talk about a term that might sound a tad intimidating: volatility. Think of it as the roller coaster ride of the stock market. Some days it's up, some days it's down, and some days it feels like a loop-de-loop. Volatility refers to the extent of these price swings. And you know what? It's perfectly normal. It's like the heartbeat of the market. High volatility means more intense ups and downs, while low volatility is like a calm river. Understanding this rhythm is crucial for making informed investment decisions. The importance of a diversified portfolio. Here's a golden nugget of wisdom: never put all your eggs in one basket. Diversification is like having a safety net for your investments. It means spreading your investments across different types of assets like stocks, bonds, and maybe a sprinkle of real estate or commodities. This way, if one area takes a hit, the others can help cushion the fall. It's a smart strategy to help manage risk and aim for more stable, consistent returns over time. We'll dive deeper into how to do this effectively later on, so don't you worry. Let's get you started on your investment journey. The importance of research. Alright, before we jump into the exciting world of investing, let's talk about the essential first step: research. It's like studying for a test, but instead of grades, you're aiming for financial success. Get curious. Read up on different companies, industries, and market trends. The more you know, the better equipped you'll be to make informed decisions. Don't worry, you don't need a PhD in finance to get started. We'll keep it practical, easy, and fun. Setting investment goals and risk tolerance. Picture this: you're planning a road trip. Before you hit the road, you decide where you want to go and how much time you have. Investing is a bit like that. You need clear goals. Are you saving for a dream vacation, retirement, or something else entirely? Knowing your goals helps shape your investment strategy. And here's the thing about risk: it's like choosing your route. Some roads might be scenic but winding, others more direct but with less adventure. Understanding how much risk you're comfortable with is crucial. It ensures you're on the right path to reach your financial destination. The concept of a brokerage account. Now, let's talk about the nuts and bolts. To start investing in stocks, you'll need a brokerage account. Think of it as your passport to the world of investing. It's like a digital wallet where you can buy, sell, and hold on to stocks. There are plenty of reputable platforms out there, and we'll explore some options later. It's user-friendly, secure, and it opens up a world of opportunities. So, if you're ready to turn those research insights into action, opening a brokerage account is your next exciting step. Let's dive into the different types of stocks. Common and preferred stocks differences. Alright, let's talk about the two main players in the stock market: common and preferred stocks. Common stocks are like the rock stars of the stock world. When you own one, you're not just holding a piece of the company, you're also getting a say in how it's run. Preferred stocks, on the other hand, are a bit more like VIP tickets. They usually come with some extra perks, like priority in receiving dividends. It's like getting access to the best seats in the house at a concert. Both have their advantages, and we'll explore them in more detail later. Growth versus value stocks. Now, let's add a little spice to the mix: growth versus value stocks. Growth stocks are like the fast runners in a marathon. These companies are expected to grow at a rate faster than the average. Think of tech giants that keep pushing boundaries. Value stocks, on the other hand, are like hidden gems. They might be undervalued, trading for less than their true worth. These could be companies with solid fundamentals that the market hasn't quite caught on to yet. Each type has its own unique flavor, and knowing which one aligns with your investment style is a key ingredient to success. Dividends in brief. Dividends, the icing on the cake of stock ownership. When a company makes a profit, they sometimes choose to share a portion of it with their shareholders. It's like a little thank you gift for believing in them. This is what we call a dividend. It's a regular payout, like a bonus, and it can be a sweet source of passive income. Some investors love companies that are generous with dividends, while others prefer companies that reinvest all their profits for growth. It's all about finding what suits your financial taste buds. Let's dig into the crucial process of researching and selecting stocks. Introduction to fundamental and technical analysis. Alright, now that we've got a good grasp of the basics, let's talk about how to pick the right stocks for your portfolio. There are two main methods, fundamental and technical analysis. Think of fundamental analysis as looking under the hood of a car. You're examining the company's financial health, management team, and market position. Technical analysis, on the other hand, is like reading the road signs. It involves studying price charts and patterns to predict future movements. Both methods have their merits, and we'll explore how to use them effectively to make informed decisions. Key financial metrics to consider. Now, let's talk numbers. When it comes to evaluating a company, there are a few key metrics to keep an eye on. The P/E ratio, or price-to-earnings ratio, is like checking the price tag on a product. It tells you how much you're paying for each dollar the company. Then there's EPS, or earnings per share. It's like your slice of the company's profits. We'll also touch on other important metrics like debt levels, revenue growth, and more. Understanding these numbers is like having a compass to navigate the stock market. The importance of due diligence. Here's a golden rule in the world of investing: due diligence is your best friend. It's like doing your homework before a big test. Before you invest in a company, take the time to thoroughly research it. Read annual reports, listen to earnings calls, and keep an eye on industry trends. Look for any red flags or potential opportunities. This level of diligence not only helps you make informed decisions but also builds your confidence as an investor. It's your ticket to success in the world of stocks. Let's talk about building a diversified portfolio. The benefits of diversification. Alright, let's dive into a strategy that's like having a safety net for your investments: diversification. Picture this: if you had all your money invested in just one company and something unexpected happened, you could be in a bit of a pickle. Diversification is like spreading out your bets. It's about not putting all your eggs in one basket. By investing in a variety of different stocks, you're reducing the impact that any single stock's performance can have on your overall portfolio. It's a bit like having a mix of different instruments in a band. They all play a role in creating a harmonious melody. Different sectors and industries. Now, let's talk about where you'll be placing your bets. Different sectors and industries are like distinct neighborhoods in a city. Each has its own flavor, its own rhythm. Some might be bustling with activity, like the tech sector, while others might be a bit more steady and established, like utilities. It's important to have a good mix. That way, you're not only taking advantage of potential growth in specific areas but also spreading out any potential risks. It's like having a well-balanced meal. You want a bit of everything for a healthy, robust portfolio. Index funds and ETFs as options. Alright, here's a nifty shortcut to diversification: index funds and ETFs. Think of them as the ready-made platter at a buffet. These investment vehicles pull together a bunch of different stocks, bonds, or other assets into a single fund. When you invest in one of these, you're essentially investing in a slice of a whole bunch of companies at once. It's like getting a taste of the entire market without having to handpick each stock individually. They're cost-effective, low-maintenance, and a great option for beginners or those who want a hands-off approach to investing. We'll explore more about these in detail later on. Let's explore some strategies for long-term success in investing. Dollar cost averaging. Now, let's talk about a nifty technique called dollar cost averaging. It's like being a savvy shopper, but for stocks. Instead of trying to time the market perfectly, which, let's face it, is a bit like trying to predict the weather, you invest a fixed amount of money at regular intervals, say every month. When prices are high, you buy fewer shares, and when prices are low, you buy more. Over time, this strategy helps smooth out the highs and lows, so you're getting a solid average price. It's like getting a good deal on your favorite snack every time you buy it. This approach takes the stress out of market timing and can lead to steady, consistent growth over the long run. Reinvesting dividends. Here's a gem of a strategy: reinvesting dividends. When a company rewards you with a dividend, you have a choice. You can pocket that cash, or you can put it right back into the company by buying more shares. It's like planting seeds from a fruitful tree to grow an even bigger orchard. Over time, those reinvested dividends can compound and boost your overall returns. It's a powerful way to accelerate your wealth-building journey, and it's one of the keys to long-term success in the world of stocks. Avoiding emotional trading decisions. Now, let's talk about a crucial piece of the puzzle: emotions. Investing can sometimes feel like a roller coaster ride. There are ups, and there are downs. But here's the thing: making impulsive decisions based on emotions can lead to costly mistakes. It's like letting your feelings dictate your path on a hike instead of following the map. It's important to stay calm, stick to your strategy, and remember your long-term goals. Having a well-thought-out plan and sticking to it, even when the market gets a bit wild, is one of the surefire ways to achieve success in the world of stocks. Let's talk about some risks and pitfalls to watch out for. Common mistakes beginners make. Now, let's have a heart-to-heart about some common missteps that beginners often make. One of the big ones is chasing trends. It's like trying to catch a shooting star. It might seem thrilling, but it's not a reliable strategy. Just because a certain stock or sector is the talk of the town doesn't mean it's the right fit for your portfolio. It's important to do your own research and not get swept up in the latest buzz. Remember, investing is a marathon, not a sprint. We'll explore some solid techniques to stay on course and make steady progress. Market volatility and how to handle it. Next up, let's tackle the topic of market volatility. Think of it as the weather on your investment journey. It can be unpredictable and sometimes stormy. But here's the thing: volatility is completely normal. It's a natural part of the market's ebb and flow. It's like waves in the ocean. Now, how do you handle it? Well, having a diversified portfolio, like we talked about earlier, can act like a sturdy boat in choppy waters. It helps you ride out the storms and stay on course. Additionally, keeping a long-term perspective and not letting short-term fluctuations dictate your decisions is key. We'll equip you with some solid strategies to navigate through volatility like a seasoned captain. Remember, every investor, even the pros, has faced these challenges. It's all part of the journey, and with the right knowledge and mindset, you're well equipped to steer your financial ship towards success. Let's talk about how to keep your investment journey on track. The importance of regular check-ins. Now that you've set sail on your investment journey, it's important to keep your eyes on the horizon. Regular check-ins on your portfolio are like a compass, ensuring you're headed in the right direction. This doesn't mean obsessively watching every tick of the market that can lead to unnecessary stress. Instead, it's about taking a measured approach. Maybe a monthly or quarterly review to see how your investments are performing. It's a bit like making sure your car is running smoothly by giving it a checkup now and then. This way, you can catch any potential issues early and make adjustments as needed. Rebalancing and adjusting based on life circumstances. Life isn't static, and neither should your investment strategy be. As you navigate through different stages of life, your financial goals and circumstances may change. That's where rebalancing comes into play. It's like fine-tuning your instrument in an orchestra to make sure every note is in harmony. Rebalancing involves adjusting your portfolio back to its original allocation if it's drifted due to market movements. Additionally, life events like getting married, having children, or nearing retirement might call for a shift in your investment approach. It's important to periodically reassess your goals and adjust your portfolio accordingly. This way, it stays aligned with your ever-evolving financial journey. By regularly monitoring and adjusting your portfolio, you're taking an active role in ensuring that your investments continue to work in your favor, no matter what life throws your way. It's all about maintaining that steady course towards your financial goals. Let's wrap up this informative journey on investing. Well, there you have it, future investors. We've covered a lot of ground today. From understanding the basics of stocks, to diving into strategies for success, you're now armed with some powerful knowledge. Remember, investing is a marathon, not a sprint. Start with small steps, do your research, and don't be afraid to ask questions. The world of investing is yours to explore. Now, it's time to take action. Whether you're looking to grow your wealth, save for a big goal, or secure your future, investing can be a game changer. So, why wait? Start your journey today. Open that brokerage account, research those stocks, and take those first steps towards your financial goals. You've got this. Before we wrap up, I want to extend a huge thank you for joining me on this investing adventure. Your interest and enthusiasm mean the world to me. If you found this video helpful, please give it a thumbs up, subscribe for more valuable content, and don't forget to hit that notification bell so you never miss an update. And of course, I'd love to hear from you. Drop a comment below with any questions, thoughts, or topics you'd like to see covered in future videos. Until next time, happy